Welcome to our October edition of Markets in 2 Minutes. This is Darrell from the Wealthspire Investment Team here to walk you through some of our latest thinking on equity markets. And we chose to focus on a broad equity market update here this month, in part because of just how incredible the rally has been over the past several months across the equity market. Despite the pullback in April, the S&P 500 has achieved 34 new all-time highs this year, at least as of this recording, and the MSCI EAFE index, which measures a broad basket of non-US stocks, has logged 36 new all-time highs. And that's despite the fact that just 6 months ago in April and May, we were in a roughly 20% drawdown for equity markets. And so we very quickly climbed out of that hole and started to reach new highs. And so, why is this happening? Well, it's a combination of things, including the fact that the economy has been holding up much better than anticipated amidst tariff headwinds. And in fact, we've seen some signs that growth is even starting to accelerate. And that's helped market sentiment remain really strong. But the other part of this continues to be the AI trade. There is just incredible optimism around what the possibilities of AI represent for corporate profitability going forward. And there's a massive amount of capital expenditure being invested into the build out of the infrastructure and technologies needed to push innovation further. But as this has continued to evolve, we've gotten a lot of questions from clients about whether this has been too much too fast. And while a healthy dose of skepticism is warranted anytime you see melt-ups like this in equity markets, there's one fact pattern here that we think is really important. And that's what I want to highlight here on this next chart. There's been a lot of speculation about whether we're finding ourselves in a tech bubble 2.0 type of scenario. But from our perspective, the missing ingredient in terms of that bubble narrative is leverage. And this chart here is showing you how much debt S&P 500 companies have had on their balance sheets relative to their earnings power as measured by EBITDA. And if you go back to the early 2000s, you can see that corporate balance sheets were far more levered than they are today. And so up to this point, the vast majority of AI investment has been funded by equity and from massive amounts of free cash flow that these companies are generating. And historically speaking, asset bubbles, and I'm going to put that in quotes, that are funded by equity tend to be far less damaging than those funded by credit. That doesn't mean that valuations can't or won't correct from here. And depending upon how such a scenario unfolds, that could spell temporary pain for investors. But until we see more significant signs of leverage and debt financing across the system, we aren't going to be sounding the alarm for any kind of major re-rating in equity markets that bleeds into other areas of the economy. I will say that we are starting to see some early signs that we may be at an inflection point when it comes to debt financing, and that's something we're watching really, really closely. But this evidence, as of now, to us, suggests that we aren't quite at the point where we're getting concerned about excessive risk taking. So we hope this was some helpful perspective, and we'll look to come back to you next month with some additional market insights. See you all in November.